All right, good afternoon, everybody. Hope everyone survived the day. I think our game plan was really on point today, though, actually. All right, let's hop right in. I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. My position disclosure is unchanged as of yesterday. Unchanged. The only difference would be that I'm actually a good bit heavier than I was yesterday. Continuing to build in on the way down as we start to extend and as we start to get towards some more key support levels for this market, which I'm happy to talk about. Yeah, wow, nice pop in the IWM there after hours. All right, yeah, pretty weak day on Wall Street. Are we popping across the board here after hours? We are. SPYs are up 80 cents after hours. So right now, including this after hours pop, we're still down 1.3%. So we actually closed much worse than that. The Qs here have popped less after hours. Looks like just 20 cents or so, maybe. Right? I had this right on the SPY pop. Is it accurate, or did I just make that up? Yeah, that is accurate. It's weird that my SPY level 1 is giving me today's closing price, but my QQQ level 1 is still giving me yesterday's closing price. Qs here are also up after hours. Okay. Yeah, that's what was confusing me, was my level 1 data there for a second. Qs are up 60 cents after hours, still 1.3% down. And the IWM also giving a nice little 50-cent pop here after hours. Is still down a percentage point. So it just shows you how weak today was, because I just had some pretty nasty numbers there, and we actually just had a really good pop the second that this market closed. Yeah, so really weak day today. I don't think we should be surprised. So we discussed in this morning's game plan, we were looking at a lot of the data from Pat's note, and the hedge fund short positioning is starting to get pretty extreme again. And the short positioning is similar in some ways to what we saw at the end of last year and the beginning of this year, which was one of several factors that had me bullish at the end of last year and the beginning of this year. Pretty resolutely bullish. But what we also discussed is that the other factors that were there at the end of last year and the beginning of this year aren't there yet. So, for example, the vol control funds. Like, what we're still seeing is that if the VIX continues to move higher and we're getting wide ranges from the market, those vol control funds still have a lot to sell. That was not the case, I think, at the end of last year, the beginning of this year. If anything, that was an extra layer of probability that they could re-leverage if volatility comes down, which it did, and cause more buying. So you could have the vol control at the beginning of this year, let's just say, / end of last year, you could have the vol control funds coming back in and re-leveraging and actually helping to squeeze the fund shorts that were, pretty dramatically positioned at that time. Sentiment was super bearish at that point. The Goldman Sachs they call it the Goldman Sachs sentiment indicator. Let me just pull up Pat's note, but it's really a positioning indicator. I know we've discussed that in the past. Maybe Pat can give more guidance as to why they call it a sentiment indicator when it's really providing positioning. But that's another thing that was way more extreme back at the end of last year, the beginning of this year. Where is that? Right here. It's really tight right now from Pat's note because it's like a note of a note. But at the end of last year, it was like at this extreme light positioning. Right now, it's just pulled back from stretched positioning to neutral. And what I was just talking about with those vol control funds, you can see that in Charlie's note here, the vol control funds have a lot to sell still. 15.9 billion of new selling over the course of next week, this week, if we are having ranges that are 1% or more, and obviously we had that again today. So that increase in the VIX, that increase in movement in the market actually creates more selling. So selling leads to more selling. If we could get a tighter day, then it would actually bring buying. This is again as opposed to I think at the end of last year where we were starting to come into an area where I don't think that the selling was anywhere near this extreme, even at larger amounts. So one thing that I pointed out in the morning meeting was that we're in a negative gamma environment. So that means it's easier than it would be in a positive gamma environment. It's easier to get these 100 basis point plus changes in the marketplace than it would be in a different environment. So that can make it easier for us to get the selling that leads to more selling, which is exactly what we had. So again, we got the hedge funds that are starting to get heavy to the short side, but these other things from sentiment and positioning and vol control and everything else are not yet supportive of this market. We're also in a buyback blackout period. Spoke a little bit about that this morning, which is also not supportive of this market. We're also still in our post-September OPEX window of weakness here with weak seasonality with this back half of September, which is also against us. So again, it's like you got the funds very heavy to the short side, and that is notable for if the market can continue higher, that you could squeeze them. But you don't have the other factors that are really coming into play yet, like we had at the end of last year and the beginning of this year, that are also supportive. So I'm not surprised to see the down day today. What we discussed in the morning meeting from a strategy perspective, we were gapping down pretty big, but still above yesterday's low. Yesterday was a potential pivot low in a market that was finally getting somewhat extended on a day 4 down. It is more typical than not to actually get continuation of yesterday's bounce today. It is less typical to have that potential pivot low come in yesterday that immediately breaks today. But I think that with those other factors that we discussed, this is not surprising. And one of the things that we did discuss in the morning meeting was the initial game plan. I like the idea of being long versus yesterday's low. But if yesterday's low breaks, if you start losing yesterday's low in the indices, watch out. Get out of the way. Manage your risk. Potentially, there were even some short setups out there with some of those inside days. The Apple support break we discussed briefly in the morning meeting. The Amazon inside day was potentially shortable. We discussed that in the morning meeting as well. But generally, while we were above that pivot high, gap down above that pivot high, it makes sense. It's a good risk reward to be taking your longs because after yesterday's candle, you have a good probability of getting a snap back to that, at least that ADMA. But breaking yesterday's low signals a failure of that. Get out of your longs. You could potentially even look for momentum shorts in that situation. And then the thing I discussed, if we break, I think I literally said this, if we break yesterday's low today, then we might be looking at a move to 425.50 or so, which could start to give us about $10 of extension on the ADMA on the daily chart of the SPYs, which is exactly what happened. It's exactly what happened. So we didn't get the bounce higher. I am still supportive of those opening longs, and there were some good opening longs this morning, by the way, in relative strength. I think I was able to say within 3 minutes of the market opening, the strength is not in big cap tech, the strength is in growth, the strength is in energy, the strength is in KRE, the strength is in XBI. And there were actually some really good opening longs off the open for momentum before this market actually failed. And they were good trades. ARC I missed, but I was talking about this ARC, which was a great opening bounce here in the beginning of the day. Some of you guys were all over this XBI. Don't tell the biotech sector, which is super beaten up on the daily chart, but don't tell the biotech sector about how the market got rocked today because XBI is up 2%. So this was an opening long that you guys were all over. A bunch of you guys were calling out longs in XBI or longs in Labu, which is just the leveraged ETF of XBI versus the opening low. Those were really good trades. We were looking at some of these growth names that were showing relative strength off the open in conjunction with like DeMark buys. Obviously, the market ended up fading a bunch of those down, but snow off the open versus the low was okay. Path off the open versus the low, we recognized that one right away, was pretty decent. Energy was really strong right away in the beginning of the day also. So we had some great, I think, opening longs that actually took advantage of our gap down that was still above yesterday's high for the market in things that were relatively strong. And almost immediately we were like, wow, Apple, Microsoft, Microsoft actually to a little bit of a lesser degree, Amazon, Google, just all super weak off the open. This is not where the strength is. So, I mean, I don't think we could have had a better, execution of our strategy off the open. Not to say that it was easy. You really had to make sure that you manage your risk, because with the exception of like the XBI bounce, I guess really with the exception of this XBI move off the open, almost all that stuff eventually did fail because the market caused it to fail. The market was super, super weak today. But there were some names off the open that were great. And then by 10, whatever this low was, when I was about to have to leave to go get some vaccinations for the doctor for this Africa trip I'm doing, we called finally for the extension longs, right? So it's like, I mean, this is great, right? We recognized what was relatively strong off the open, great momentum trades. We recognized what wasn't strong off the open to be able to stay away from it. We recognized when those weakest things were getting most extended, the market was getting most extended again at like 9:15 to look for longs. Recognize that these are counter trend trades that are basically designed to take advantage of extension on that time frame. So hopefully no one got hurt. There was enough of a move in most of those ones on the upside to be able to make some money and get out of the way. And then eventually new lows came in, and once again you have to stop your out. You have to stop yourself out. You have to stop yourself out. So as long as you were willing to stop yourself out of things today, if you were trying to buy the indices versus yesterday's lows and you stop yourself out, I think that's a great trade. Like if you were trying to buy SPYs off the open versus yesterday's low, I hope the bounce was enough to get your risk covered, whether it was or it wasn't. And as long as you stopped yourself out at the right time, which is on the 950 break, 950 5-minute bar, I think that's a really good job. I think that's really good trading. It's being on the right side of the market. And if instead of doing it in the indices, you focused on the names where the strength was, if you bought ARC, if you bought Labu, if you bought XBI, if you tried a snow or a path, those are also, I think, great trades. But then you have to kind of get out of the way when their lows are breaking, because risk management's the key. And then you could have, and this was really not my focus today, but you could have shorted Amazon through yesterday's low, when Amazon showed that it was failing. You could have shorted, and we talked about 2 days in a row the importance of 173.50 in Apple. You could have shorted Apple through 173.50. That was not my side of the market. We're starting to just get a little bit too extended to the downside for me, for the way that I trade, to look for shorts here now. There was plenty of opportunity to be short the market. I mean, not only did we call the actual highs in July, we called the high of this bounce that was in the second half of August and the beginning of September. I remember not getting filled on my TQQQ short on September 1st by 1 penny up there, so I never really caught that short. But then we expected, with the options expiration, I mean, I had been talking about it this entire week here, leading into the September options expiration, that it could create weakness in the market. So there was opportunities to get short. I was still, in hindsight, thrown off by that Fed event, and really the day before the Fed. I thought that the day before the Fed was very supportive of the market. Sorry, I'm just distracted by something here. Just give me 1 quick second. Sorry about that. I thought that the day before the Fed was actually very supportive of the market, and it kind of threw me off with that Fed, and I totally misread the Fed on that day as well. So if I drop the ball anywhere, I dropped the ball basically on the Fed day with the downside follow through that came from that point. I'm not surprised by it. If anything, I was expecting it. I really did not do a good job capturing it. And it all kind of leads to where we are today. So with where we are today, the market on a closing basis, the SPYs here, has given a pullback of over 7%, which again, that's a standard technical pullback. It's not even a market correction, right? Market correction is technically 10% plus. We're at 7% or so right now, and I think the statistic, I mean, I say it often enough, so I hope it's right. It's been a while since I looked at these historical numbers. I like to look at these historical numbers because it tells you how prepared you should be for different market scenarios, even though every situation is always unique. I think that you get a pullback between 5 and 10% in the market on average every 8 months, on average historically. Obviously, there could be periods of times where maybe you go a year plus and you don't get that. I think we had that in 2019. Other periods of time where you get them more frequently. But for the moment, this is a run-of-the-mill pullback. And given that we were up at, almost 460 for the SPYs, and now we're at, 426, and we're almost at $10 worth of extension, I think that we're closer to the end of this down move than we were to the beginning of it. And as we become, $10 extended in the SPYs and the Qs, that's where my game plan tells me to begin to get more aggressive on the long side. I started to do that today, but I'm doing it with a little bit of nervousness because we are still in this weak period here, right? Back half of September and maybe the very beginning of October, we're still in this period where we can be weaker post-OPEX. I am really eyeing the space between the 200-day and the SPYs and 420. We know 420 or SPX 4200, which probably roughly coincides with SPY 420, is a massive, massive support level. Pat mentioned when he was chatting into the close that he thinks, it might not just be as easy as coming right down to 420 and then bouncing and holding support perfectly. I actually think it might be as easy as that. But we need to see what the price action looks like when it gets down there. Maybe they don't get us all the way down there because we're getting so extended and a bounce starts, or maybe they do and they overshoot it. But as we're starting to really extend to the downside, I certainly recognize that we could continue tomorrow, because we're just about at $10 of extension, but that ADMA is going to be moved a little bit lower tomorrow, so we could move down. And technically today was a day one, right? We had a 3-day down move and then a gap down on Monday. So yesterday was a day 4 gap down, but we closed green, so that resets everything. And again, breaking yesterday's low today, when you have an attempted pivot and you get no follow through on the bounce, tends to be a very bearish signal, and it resets you. So today was technically a day 1 again. I really like my ideal setup, if I could just kind of create the ideal setup out of thin air, is like day 3 or day 4. Honestly, if I'm making it the ideal setup, it's going to be day 4. Gap down with $10 plus of extension. So honestly, a little bit more, $12 of extension into a major support level. That's like my ultimate like 10,000%. I'm coming in on the other side of the market. Let's go for it. Trade, where I'll go all in and put on a tremendous amount of risk. We don't have that perfectly lined up like that at this point, and we almost never do, right? We almost never do. I remember February 2022 when we gapped down on the Russia invasion of Ukraine was one of those setups. It was like a day 6 to the downside, massive gap down on news that should have already been priced in the market, and we came in and were very aggressive to the long side on that day, and it was a extremely fruitful position to put yourself into. So we're not at that perfect setup yet, and we very rarely get it. So, like anything, when you're judging the market, you're judging the different layers of probability. What is there on your side? What is not yet there on your side? It's always good to recognize both the bull case and the bear case scenario for any trade, which, again, that's something we did this morning, right? And maybe I should qualify the thought process a little bit better on some mornings with a bull-bear case. Right, the bull case this morning was common gap down, but still above yesterday's support level with some degree of extension. Yesterday's pivot level with some degree of extension, though not massive downside extension in the market, so there's room to bounce, and the gap down gives a good risk reward, and common gaps tend to get filled. That was the bull case. The bear case is this market's been very weak, and the gap down brings you dangerously close to yesterday's low. If you lose yesterday's low, especially if that happens post 9:45, 10 a.m., that it could really lead to a whole nother level of selling, which is exactly what happened. So we're prepared for both that bull case and that bear case. We're identifying and studying the different layers of probability with any situation with the market. So, we'll assess how we gap tomorrow. A gap down tomorrow, if we can gap us down to, I don't know, where do we close? Like 425.50? If we could gap down to 424 or below tomorrow, we definitely would have the extension, but it would still only be a day 2, and you still wouldn't be at the massive daily support level, and you still would be within this window of weakness. So they could overshoot it further and then give us a day 3 at SPY 420 with $13, $14 worth of extension as well. Panic selling is coming into a big support level, and then that becomes the probably the more ideal situation to come in on the other side. But thinking big picture here, I'm looking at a market that's trading at 425 and it's about $10 extended from the ADMA. And if I really think that this 418.50 to 420 is major support, that the bulls, I think, are going to put up a real fight there, in conjunction with the fact that we came down from SPY 460. It's like we're, $5 away from the major support level that I'm looking at, and we are, $35 away from the highs that were just seen as recently as a month and a half ago. So, excuse me. So big picture, I'm starting to like the risk reward much better to the long side again, especially compared to how I was feeling at the end of July when I actually was able to, flip net short up there. Small picture is where the execution of the big picture comes into play. And that execution is more difficult, because it's like, on the one hand, if my sizing is appropriate and I can build in properly, I love the idea of starting to build in heavier at SPY 425, but I better be prepared not just to see 418.50 to 420 as where a real, for lack of a better term, bottom comes in, but the potential of an overshoot to 415, which is still $10 a downside from here. At the same time, I like the idea of starting here, because with $10 of extension, there's also a situation where we never see anywhere like 415 to 420. And we, begin to get an oversold bounce off of these levels here, and then it gets us through the rest of this window of weakness, and then, a higher low comes in the market, and we start working our way back into the 440s. So I like the idea of beginning to build in more aggressively here. I am, but at this point, if you're doing that here, you've got to be big enough picture that you can afford $10 worth of downside, or you really wait for the small time frame signal execution, which is always what I prefer to do anyway if it gives it to you. It's just that, as we know, the market doesn't like to give it to you sometimes. Ben Kahn, when he jumped in here real briefly, was like, and if you know Ben, he's a very sarcastic guy. But he's like, is anyone really going to be surprised if we just gap up tomorrow and they take us back to the ADMA on the daily? But I know that there's a degree of sarcasm there, but there's also a degree of truth with just how the market loves to frustrate people. Because how many people after today's weak close are willing to take anything to the long side? So I won't be surprised to see a gap up rally tomorrow. I also won't be surprised, because today was only a day 1, to see continuation of today's selling, to see a gap down, to see broader continuation where we get into 420 to 422.50 for tomorrow. I think is on the table for sure. And I, with the fact that I started to build in a little bit more aggressively today, especially the second half of today, as we started to get $10 worth of extension, but I'm still leaving room for the pull to 415. I'll take either situation. I'll take either one of those situations. If you want to gap us up tomorrow and not let anybody in, and then rally us back into the 430s, and then over the course of the rest of this week get us back to the ADMA or 436 or something like that, I am now heavy enough where I will love that and I will do really well with it. At the same time, from risk perspective, like I said, giving myself some room. If we get the big gap down tomorrow that leads to just an incredible large buying opportunity, in the low 420s as we're $12 extended away from the 80 MA and finally getting to daily support, and the market's beginning to panic a little bit, and we can come in on the other side of the market there, I also welcome that scenario. The scenario that I don't want is like the price action that you guys saw on Friday of last week, or honestly even the price action we saw yesterday, because like I was saying in the afternoon meeting yesterday, it's like, yeah, we gave a pivot low and we closed on highs, but I kind of thought that was a BS trading day. I said that in yesterday's afternoon meeting because there was no volume. The rally came into the close. The rally seemed very weak-handed. So I'll take that gap and go to the upside to frustrate everybody. I'll take that big gap down to continue our extension and give us a signal to come in now on the other side of the market. What I don't want is a repeat over the course of the next two trading sessions of what last Friday and yesterday were, which was they were basically 2 days of bearish consolidation. I know, Friday into the weekend, and I wasn't around as much because I was presenting in Las Vegas, but I know it was choppy day that then rolled over and closed on lows. It was a bearish consolidation day. Yesterday, gap down, they rallied off the gap down, but then we went sideways all day and rallied a little bit into the close. It was basically a bearish consolidation day. That's the scenario I don't want to see over the next couple of days. That'll be a frustrating scenario because it will enable the market, if anything, that would be the most bearish situation. I think it would be more bearish if we spent the next 2 days going sideways than if we had the gap down or heavy sell into the low 420s that I was talking about, because that leads to more of a real buying opportunity to come in on the other side of the market. So certainly an interesting day. I'm going to look forward to seeing how we gap tomorrow. I'm going to look forward to Pat's note tomorrow. Look forward to see if we can get any of that updated positioning, updated market dynamic stuff. Look forward to Pat's note. Look forward to if Bill's got any information that he can provide there as well tomorrow morning, just update-wise. I think we're at the point where that information becomes really important. And it was like I said in the morning meeting today, Pat's note was great today. It gave a great overview of just where we are as far as broad market dynamics and market positioning and sentiment. And it was data that showed that we're not there yet. We're not at the. It wasn't saying conviction long yet, is for sure. So that is pretty much all I got. I think it covered kind of the trading during the day today, which today was a complex day, but I think if you followed the game plan to the real letter of the law, that it was a really good trading session. If you followed along with things, there's a lot of opportunity. Honestly, on both sides of the market. Obviously, the longs were more difficult, but some of those longs off the open were great. And that's also, I think an update on the big picture stuff. So I am happy to answer any questions that anybody has. What's Costco doing? I wasn't able to look at it at all. Costco down after hours. Revenue beat. EPS crushed. I mean, maybe not crushed, but EPS did pretty well. All right, so Costco not saving the market. I think first thing I'm seeing is maybe from Eddie Vick. Nope, not a question for me. He's just commenting on Costco. From Fernando, for swing trades, do you recommend entering at a specific time of the day? I prefer earlier in the day, generally, for all my execution. Whether it's swing trading or day trading, I prefer early in the day. When it comes to swing trades, I generally only like to swing positions overnight if I'm already in the money on that position. So it's difficult and scarier to do that without a profit cushion. The profit cushion puts you in what we call a win-win situation, which there's no such thing as a full win-win situation because bad news could always come out and the market could gap down. But if I take a trade earlier in the day, I have all day to build into a profit cushion that will help me with manage overnight risk. If I'm buying it into the close, like today, it made sense to buy some stuff into the close today for the scenario that they gap us up and don't let anybody in tomorrow. But I think it's a much riskier trade because they could gap us down tomorrow. It's like you're kind of flipping a coin there a little bit. I mean, maybe not fully flipping a coin because you're recognizing the daily chart downside extension for the market. But without the profit cushion, you're potentially putting yourself in a tough spot. So I like the idea of entering my swings earlier in the day, and if they don't close well that day, exiting them and just reassessing tomorrow. And if they do close well that day, well then you got a good profit cushion of open P&L to be able to hold that just in case the market gaps down against you or something like that. So I hope that helps, Fernando. I appreciate the question. From Varun, are Boeing and Disney going to go bankrupt or will they ever recover? They're not going bankrupt. Interesting that Boeing never broke yesterday's low. We spoke about that one actually a little bit in the morning meeting today off that pivot. Interesting to see Disney back at 80. Interesting to see this Disney back at 80. I thought that was the bottom when it ticked through 80 in early September and snapped back up, and the news was starting to improve a little bit. I really thought that was it. The market hasn't been helping, obviously. The market is probably helping push Disney back to those September lows. So maybe we wouldn't even be retesting it if it wasn't for the market weakness. But I like Disney long in these levels if you're big picture. Almost like I like Disney honestly as like an investment at these levels. I think it just trades really cheap here. From Eddie Vick, if I understand you correctly, are new shorts here too risky and not suggested given we are still $10 of extended? For the way that I trade, the answer is yes. If you're a very small time frame momentum trader, you could still take shorts no matter how extended we are because you're going with momentum. But I can tell you, when I look at the SPYs and the Qs and I measure extension, the kind of general rule that I have is if the market is bullish and we are between 0 and like $5 to $6 of extended, I want to be buying. If the market is bullish and we're between like $5, $6 of extended and $9 of extended, that's what I consider to be no man's land. So you can look at either side of the market there based on relative strength and relative weakness. But that's the area where new longs are tricky because we're kind of extended. But new shorts can be too early because we're not extended enough. And if we are trading at $10, really, I always say 10, but it's really kind of 9. But let's stick with 10. If we're $10 above the ADMA or more, for me that means no new longs and potentially shorts and building into shorts as I piece out of longs, especially if I'm already long, I want to be piecing out of longs and building into shorts that can also hedge myself a little bit. You can take that exact same logic now and apply it on the downside. Market is breaking lower, so we're below the moving averages. We just snapped back up and we're trying to create a lower high in that equilibrium area, whatever it is. The closer we get to that ADMA in a bearish market, the more I want to be shorting. So if we're between $0 and $5 extended down from this ADMA, I want to be a short seller, not a buyer. If we are between $5 and $6 and $9 and $10 down from the ADMA, that's that no man's land. The short risk reward is very difficult there to continue to press the shorts, though it absolutely can still pay you, especially if there's momentum. But it's too early to come in on the long side because that momentum could push us down, significantly further, and you could be hurting yourself. And then finally, when we become $10 plus extended, and the more extended, the better in some ways, which is kind of where we got to today. That is where I will not be putting on any new shorts. I do not like the risk reward on new shorts. Again, there could still be momentum. $10 of extension can become $13 of extension. There can still become momentum, but the probabilities are starting to get stacked against me because of that extension. The risk reward there is no good unless, again, you're a pure momentum trader, which I am not. There are people on our team here in the VTF who are. So if that's your approach, if you're, primarily a day trader and you are a momentum day trader and, the market's gapping down $10, but there's panic selling that brings us to $12 of extension, and you can take advantage of that extra couple of bucks there, then go for it. And there's people here who trade like that and make money. Not me. That's not for me. I'm a little bit bigger picture than that. So for me, once we get to $10 plus of extended, it means definitely no new shorts. The risk reward's against me, and I don't care if the market continues to go down and I could have made a few dollars. It's not going to be what pays me in the long run. It's been extremely consistent. If you go back, last year plus, and obviously we had a ton of volatility in 2022, but every time we got to $10 plus extended or minus extended in the SPYs from the ADMA, you were at the point of the market snapping in the other direction or starting to get very close to it. So, I am going to assume that the same thing applies, even though I work in a game of probabilities. So, is there a realm where we could get to $20 extended? Yeah, and we did in 2022 in the depths of the bear market. Like that day that I was talking about in February, that was right here. The January sell-off and then the February sell-off had us I think $25 extended from the ADMA or something, which was just completely insane on those gap. Yeah, this day on January was bonkers. The January low on the 24th, SPYs got to 439.84. Let's just call it 440, and the ADMA it's less than I thought. The ADMA was at 451, so that was $11 plus worth of extension. I thought that was more than that. I thought it was in the 20s. What about this February one? This February one was definitely really wild. February low, yeah, this one. The low is 410 and the ADMA is at 434, or basically 411 and 434 because I'm just rounding here. So you had $23 of extension. This was the day, by the way. This was the day that I was just referencing. That was the ultimate we are buying the F out of this market. We are buying the heck out of this market. There is no holding us back from buying the heck out of this market. Because these 4 days into that were on the 4 days of selling were on the expectation that Russia was going to invade Ukraine. And then that morning, Russia invaded Ukraine, and we gapped all the way the heck down from 422 to 411 that day. And I remember that was one of those mornings where I gave one of those morning meetings of just conviction buy. This is not new. This was expected. The market's just freaking out because the event sounds so scary, which it is. But the market priced that in over the course of the last 4 days of selling when we knew it was coming. And we have $23 of downside extension from the ADMA on the daily chart. This was one of the ultimate, kind of buy days. Led to this great initial move. And I remember in March, looking at sentiment and positioning and market dynamics, that we also then perfectly caught that up move in March. 2022, wild. It's fun to go back and recap that. But that was a specific event also that helped to create that degree of downside extension. So the point of what I'm saying though is, if you go back to the beginning of January 2022, and it's been a volatile period for markets. If you go back to the beginning of 2022, note every single time the market got $10 plus worth of extended from the ADMA and what happened after. Were there periods where we got to $13 extended? Were there periods like the day I just showed with the February date where an event occurred and we gapped down and we were $23 extended? Yes, there were. But those have been very consistent on the on the upside to short and on the downside to buy for bounces. And sometimes it just is a bounce's continuation of trend, right? We could, maybe this was it today, when we hit that point, or maybe there's a little bit more to it with a gap down tomorrow or some continuation tomorrow and gets us a little bit further. But eventually when the bounce comes, in some way or another, a bounce will come eventually, whether it starts today or it starts at 420, I don't know. But when you get the snapback to the ADMA, especially if you're looking at your smaller time frame technicals, and we'll analyze the multiple time frames, that's where multiple time frame analysis begins to come into play. That could potentially just be your lower high, and if we're setting up for a lower high in that area, that's where I want to short. I want to short here. I want to short here on the Fed day, even though I failed to do so. If we're talking about trend continuation, I want to short on August 15th on the break of 444, 445 support. I don't want to short on August 18th on a day 4 gap down when we were like $8 extended from the ADMA. And I remember talking about like getting the perfect trade, the perfect setup. I remember the one thing that was missing back on the August 18th low on that gap down was that we were only like $8 extended from the ADMA, and I wanted 10. But it was still a day 4 gap down and marked the bottom of August. So appreciate the question, Eddie. From Linkov. Yesterday into the close, shorted TQQQ to offset the longs I have. Okay. Shorted a third of the dollar value of my longs. Okay, that perfectly offsets it because TQQQ is 3x leveraged. Today I have been covering and playing the ping pong game. I taught you. Managing positions. I'm down to a half of my short, and I'm planning to keep it with a stop at the top of yesterday where I shorted, and profit target the equivalent of 420 in SPYs. I love it. I love everything you're talking about here. Do you have any feedback? By the way, this is the only trade for the past year and a half since I joined the VTF that I'm not embarrassed to share it as for feedback. Come on, link up. You should never be embarrassed to ask for feedback. Never be embarrassed to ask for feedback. This is how we all get better. Whether you do good things or bad things or dumb things or smart things, this is how we all get better. We're all out there making mistakes, So never feel embarrassed about it. But I love what you just described. The only thing that I would say is that when I short the indices like that, I don't really ever do it as a pure hedge. Like I don't short because I'm saying I'm taking a pure hedge. I short as a trade. So like my setup is there, my stop loss is there. If the market starts to rally or whatever, like I want to make sure that you're not shorting as a hedge and that you're holding it against you with no stop loss on the way up, or that you'll just average against you on the way up as the market bottoms or something. I used to try to do that and I had no success with it, where I'd be like worried about the market. Market's gone up a lot, so I'm going to short the market while I hold my longs, and then I just would let these shorts in the market just bleed against me and bleed against me and bleed against me, and I would waste so much money doing it, and then eventually by the time I would stop myself out, it probably was near the high anyway. That I don't like. So that's why when I put those market shorts on, I'm definitely creating a game plan that understands that I'm otherwise net long. And that game plan can enable me to give it a lot of room or be a little bit more aggressive or whatever. I know I've spoken about it a lot, in particular when we're extended the upside. It's like I'm shorting, and my game plan is to continue to add in and add in and add in until we touch the ADMA on the daily chart, because we will touch the ADMA on the daily chart at some point. And hopefully I'm not too early on my trade. So that's the only piece of feedback. But as far as the execution of everything that you're talking about, that you're kind of ping-ponging back and forth, you're getting some cash flow while that trade is playing out for yourself, you're still holding some for a bigger move, or you can continue to do it down to 420. You'll continue to, I assume, do it on the way up tomorrow, as long as it doesn't get past where you said your stop loss was. I love it. I think it's great. Back to Eddie Vick. Thanks a bunch for the clarification. I'm not a good day trader or momentum scalper as Judy. Yep, that's like one person that always comes to mind for me too. But you helped me understand a lot of what I need to do and potentially could do. Just hope I don't screw up the executions from now on. Also going to ask your opinion on support on target. I'm getting deep fried by being long. Yeah, these retail names are hard, especially the brick and mortar ones. One of the things I actually like about Chewy, not to talk about my book and not yours, is that they have no brick and mortar. That headline was so crazy that hit today, that they're closing stores in 10 cities or something because of the crime and the robberies and the violence. Um, that's insane, and I don't want this to turn into any sort of political commentary from me. I do everything I can actually to not turn this into a political room, so I'm not making a political comment at all. But arrest these people. I mean, I don't. I mean, forget about like blue, green, red, whatever your color is, whatever team you're on from a politics perspective. Is it not just reasonable logic that people who are thieves should be arrested and tried as criminals? I mean, it's just insane. That's just insane. Because and eventually, if you don't get if the law or the police or something to do something like that, I mean, does anyone remember? I mean, it was before I was born, but I know the stories of like the vigilantes in the subways in the 1970s. And I think there was that story of that guy who, correct me if I'm wrong on this. I think there was a guy in the New York City subway system in like the 70s or so when the crime was really really bad, and like his wife and daughter got killed or something like that, and then he just became a vigilante and he was just like down there like almost living in the subway looking for criminals and was just killing them one by one. And I don't want to say I support that, but at the same time, it's like if the law's not going to do something, people eventually will. It is a real story, right? Did I get that accurate? I mean, that's what ends up happening. I mean, it's just crazy. It's just crazy. I mean, I'm not a store owner, but when I grew up, my dad owned two 7-Elevens. That's what he did. So I spent a lot of time as a kid working in and being in his convenience stores all the time. I'll tell you what, he wasn't letting anybody walk out the door stealing from him. It didn't matter if it was a piece of bubble gum, and if it was some real low lives. There were some times that he took justice into his own hands before the police got there. Uh, and I don't know. I kind of support it, but it's just crazy. I mean, these companies can't even operate. These companies can't even operate. I don't know. I'm just gonna go on a rant now because I got nothing else to really say about it that's gonna be productive. But then those communities aren't even going to be able to have these stores. So then the community just rots. Like law and order is part of what this country is about. The whole point of being able to operate a business in the United States is that you have the benefit of the judicial system here, that it can enable you to do it. People just can't walk in and steal. I don't know. It's just totally nuts. Anyway, rant over. Looks like I got through the questions in the VTF. Let me pop over to YouTube. Let's see what's going on YouTube. Looks like I got through anything in there. Michael B asked me for thoughts on Geo. This is the private prison, right? Held in pretty well. It's held in pretty well recently in this market downturn. I don't follow this one super closely. I just know that the Big Short guy, whatever his name, was involved in it for a while. I like that it's holding support. I like that this thing is trying to round up. I think that this thing looks really good, all things considered. But again, it's not one that I watch super closely. With just pure technicals here, I'm seeing great relative strength. I'm seeing support that's rounding up. I think it looks great if it can get market support. Like if you can do this well with the market being weak, what's it going to do if the market ever gives a real bounce? Also, Groupon. I don't know what's going on with this Groupon. I'm surprised that this company even still exists. Does anybody use Groupon anymore? Like, does anyone use Groupon? I remember when it was a new thing, using it once or twice. Not seeing anybody in the VTF here raise their hand. But the chart looks great. This thing was green today. There were still some select growth stocks that finished green today that I was really impressed by, and I guess this Groupon was one of them. Has a high short float in Groupon around 34%. As your commentary, this is a great looking bullish pattern. Honestly, we should probably add Groupon $13 on the list for another squeeze. Backlinks to support your SEO. I don't know what backlinks is. They're having these two haven't been sound. Yeah, Michael, I like him. Michael B from YouTube, I like him. Definitely keep him on the radar. Back over to the VTF. Just reading Eddie Vic's comment that Walmart doesn't get affected by organized crime to the same degree. Yeah, I don't know. I don't know enough about the business, but I don't know. Walmart seems like a real steady Eddie. Get it? Steady Eddie? That pun was intended there. As far as their business goes, this is one that I don't really trade, but I'm a holder of it in my IRA, my retirement accounts for the big picture. From Fernando, do you use or know of any AI software that can learn based on the Strategy 1 programs? I don't. What are your thoughts on using AI in stock trading? I know it's being done a lot on the algorithmic side. I know to some degree it's actually been being done. Artificial intelligence has been used for quite some time to various degrees with robotic trading. It's just becoming a lot more noticeable now because everyone's paying attention to AI as the hype has totally been built up around it. I'm not afraid of AI coming into the markets and taking away my hedge. Would be the first thing I would say. I think that there will always be room for people. But I do think it's going to make the algorithms even that much more advanced. The one thing I used to say about the algorithms in the market is that the advantage of human beings is that we can be more flexible in how we adjust to changing market conditions than robots can. So, a algorithm is only as good as the coding behind it. So if an algorithm is created based on a specific strategy and all of a sudden that strategy doesn't work anymore because the market evolved, well, then that algorithm doesn't work anymore, and you have to take that algorithm offline, and you have to figure out what changed, and you have to reprogram it and rewrite the code, and then you can get a new algorithm back online that hopefully does a better job. And that was an advantage of being a human over being a robot, is that in that same period of time when the market is changing in such a way that the robot has to be taken off and reprogrammed, I, as a human being, can be flexible in that moment and change based on what I need and take advantage of the robot's weakness. The improving AI situation might make those robots a little more human-like, if you will, where when the environment changes, they can recognize it and potentially adjust the strategies themselves to take advantage of the new normal. So that takes away some advantage of a human. But the way I understand markets, someone please correct me if I'm wrong, is that in this stock market, different than a market of contracts, in the stock market, wealth is created and destroyed. So people commonly say or think that in order for there to be a winner, there has to be a loser. And I think that in theory, that's not true because wealth is created and destroyed in the equity market. I think in theory, though it never works out this way in practice, everyone could be a winner at the same time. That's different than, I think, a market of contracts where there is inherently a winner and a loser with every contract. But the fact that wealth is created and destroyed in the equity market, and the fact that in theory everyone can be a winner at the same time, to me means that there is always room for human beings in trading. So a common question I get all the time is, are you worried as a discretionary trader that eventually you're going to be put out of business by the robots? I've been getting that question for at least 10 years, by the way. And my answer has always been no, and it still is no, and I hope it continues to be no. I think it will. So I hope that helps with your question, Fernando. And again, I apologize, I don't have a specific software that you can look into. I don't know if anybody else does, but if they do, they can provide the information for you. Oh, Michael Berry, that's who I was looking for. He still has some geo. Gotcha. All right, gang, I'm gonna wrap it up. It's a little after 5. I hope everyone had a good, not only survived today, but had a good day. Yeah. Oh, and for sure, Eddie. Eddie Vick here saying I had a few friends blow up accounts trading futures with algos. So I'm kind of afraid of implementing them live. Yeah. I work even with T3 in onboarding both algorithmic traders and discretionary traders. The most of there's a much larger percentage of discretionary traders that join than algorithmic traders, but we bring on both. The success rate's the same, roughly, between them. And if anything, the bigger difference is that the algos are just significantly more difficult to get them online to begin with, and then they don't necessarily have, from what I've seen, any better of a success rate than anybody else or anything else. It's about the trader, really. So on that note, I'm gonna end it. Have a great night, everybody. I'll see you tomorrow.